Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Olly Newland, who is a property investor, authorised financial advisor and author, of course. Welcome in again, Olly. Good to have you with us.
Good to be back.
Look, obviously here to discuss matters property. Now we'll kick off on the policy announced by the Labour leader David Shearer over the weekend. He's talking about restricting foreign non-residents, foreigners, from buying houses in New Zealand. What is your initial take on his policy?
I think it's very sad that it's come to this. There's no need for this because the number of foreign investors who bought houses in New Zealand and don't live here is minuscule. It's absolutely tiny. And I just don't think it's necessary at all. And I think it's sad, and we should draw the curtain of charity over it.
Do you not think that, obviously he's cited Australia, among other countries, China, Singapore, who have similar policies, that we're just looking to do what other countries do anyway, and non-residents buying properties, and notably in Auckland, is one of the factors that have driven up prices here?
I don't think it's driven up prices at all. And just because some countries do or have these sort of policies doesn't mean that we should adopt it. I just think it's a waste of time. It'll affect so few people it doesn't matter, and there's so many ways around it doesn't matter. So I think we should just ignore it.
In terms of ways around it, what would be the obvious ones to you?
Well, the obvious one to use is that any foreign buyer, and we're talking Asia, aren't we? That's just the obvious thing, would just have somebody in New Zealand act on their behalf. Very simple, and hold the property in trust for them if that's what they want to do, and come to a private arrangement. It's very simple to get around.
And in terms of the broader things Labor's talking about in terms of the property market, obviously they've been advocating capital gains tax for a long time. We won't go into that today because we've talked about that before and we know your views on that. But do you think that there's anything that the politicians should be looking to do to regulate the property market in New Zealand in any way? I mean, stamp duties, anything else?
I don't think the property market needs regulating. It's self-regulating. If we watch what my words, in a few months, or perhaps 18 months, 2 years from now, the market will steady and go quiet. And that's all the sort of regulation we need. If you start interfering, you have unintended consequences down the line. If you start pushing in one area, you'll get something going wrong in another area. Leave the market alone, it'll rise and then it'll level out by itself.
Why do you see it easing back in 18 months or 2 years' time?
Well, there's a limit to how much prices can go up. And it's readjusting now. We're having a major readjustment. It should be allowed to run its course, and then it'll level out and become just a normal market where there'll be gentle rises of 1 or 2% per annum or something like that. But that's a year or 2 or 3 down the line yet.
Okay, and now the other thing that's been really dominating, I guess, media talk and discussion, and you wrote a very interesting article on recently, is the Reserve Bank looking to bring in restrictions on banks' low equity mortgage lending. Now, you wrote about how this had, obviously, these types of regulations had been in place in the past, and there was an array of ways for people getting around them. Right. So, I mean, you're basically saying if the Reserve Bank goes down this path again, people will get around it again.
If people want to buy a home for themselves, it's a very basic instinct. They find ways around it. And what happened in previous times when there were loan restrictions, where people would go to second-tier lenders, second mortgages, third mortgages, fourth mortgages, they would go to the parents, they would go to getting second mortgages back from the vendor, as well as second-tier lenders. And there's also low deposit dealers. All sorts of things were done because of loan restrictions, and this will come back for sure if these sort of restrictions get too tough.
And in terms of the article you wrote, you gave 10 examples of the way people got around them. I was really interested just on picking up on 2 or 3 of these, just to probe for a bit more information. You talked about solicitors and nominee companies. Can you tell us how these worked?
Solicitor nominee companies sprung out of the fact that many years ago it was difficult to get mortgage money. And what solicitors nominees companies do is they gather money together from investors into a pool, and then investors are money investors. Then they pool this money together and create a mortgage. And the investors usually can pick and choose which mortgage they want to go into. And they're usually more expensive than, say, a bank loan, but they were very useful in the days when you couldn't get a loan from a bank, whatever. People have forgotten you used to have a ballot to get a loan. You used to have to wait up to 5 years to get approved for a loan. but the solicitors nominee companies filled that gap, and you could get 2/3 valuation mortgages straight away, or even second mortgages. They're still around now and then. You can find that, and they'll come back with the vengeance if this sort of restrictions come in.
And another one was the low deposit house dealer,
Yeah.
which you described as usually being done by a long-term agreement for sale and purchase, an extended settlement with prior access, a bit like a hire purchase type arrangement.
I did a lot of those.
Yeah.
I did a lot of those.
So can you tell us a little bit about how they work?
Well, an honourable dealer, and I'd like to think I was one of those, would go find a house at a wholesale price and then clean it up and make it nice and then sell it at a retail price, and would take a deposit of a person, very small deposit, and then you'd remain the owner of the property, but the buyer would be able to buy it in 2 or 3 years' time. There was a contract, it was all done properly and legally, and their payments would go towards the principal. So they build up their equity in the property. In 2 or 3 or 4 or 5 years down the track, they'd pay you out because they'd built up their equity in the property. But you retained ownership, and the buyer put a caveat on the property to protect their interest. And it worked very, very well. I did, back in the 60s and 70s, I did hundreds like that. And people, even today, come up to me and say, "Thank you for putting me into my first home." It's quite a nice feeling.
So obviously the Reserve Bank is concerned about these low equity mortgages that the banks have been doing, the sort of 95%, etc., LVR, loan to value ratio type thing. Do you think that they really need to be concerned? Do you think they need to do anything in this
I think
area?
you'd leave it to the banks to decide. The banks are the ones who have the customers in front of them and know whether people can afford the 95% loan or not. It's the banks are going to carry the can if things go wrong. And I think it's quite sensible to leave the banks to, I mean, the whisper's gone out already, and I think banks are already doing it. They should be allowed to pick and choose the customers who can afford 100% loans or 95% loans, whatever, and not leave it to Reserve Bank to come down with a one cap fits all type of solution.
Okay, and look, you've also talked about the stagnant residential rental market, how you see rent rises, rent increases coming, some growth on that side. What's your thinking behind that?
Well, rents have remained, relatively speaking, stagnant for years and years and years, and the value of the properties and the rent they're getting, you're lucky if you get 2 or 3% return on your investment, and that's something's got to change. Either prices of houses come down, which is highly unlikely, or the rents go up. Now, if loan to value ratios come in, limitations come in, then of course fewer people will be able to buy a house, so they'll be pushed back into rentals, and so you're going to have rents go up. And if we have more immigrants coming in, and that's happening, and if we have less people leaving for overseas, and that's happening, then there'll be pressure on the rental market. So there's 2 pressures already, not to mention the fact they're not building enough affordable houses. So you've got all these pressures on the market, and the obvious answer to me, subject to nothing nasty happening, is that rents will steadily rise, and they should actually theoretically be double what they are now, but whether we get there is another matter.
In what sort of time period do you see them doubling?
Well, hard to give it time, but over the next 5 years they should double.
And just on one more question on the LVR issue, you said that Reserve Bank should leave it to the banks. Is there not an argument that maybe the buyers need protecting from themselves here?
You could say that.
Taking on too much debt?
You could say that, but on the other hand, you're depriving people of a home. And that's an emotional thing. The only way around the whole thing would be to allow people to rent long term. Overseas, you can rent a house for 99 years, in that case, or 100 years or something like that, and actually the lease you take back is valuable. If we had that system here instead of the macabre dance of death that landlords and tenants have at the moment, then we have a different scene altogether. But it's my mind that rents will be going up in the not too distant future, and loan to value ratios restrictions will not help.
Well, thanks for that, Olly.
Okay.
That's Olly Newland, and I'm Gareth Vaughan at interest.co.nz.